So, what would happen if we did do that? We reduce the firm's day sales outstanding to 32 days. And so, how would that affect the company? So, first we need to calculate what are the sales per day. And so, take the sales number divided by 365. So, we get 19,275. If we take our old accounts receivable, 19,275, times its day sales outstanding, 45.6 days, you get the old accounts receivable of 878,000. Now, if we take that same number and multiply it by the number we want our day sales outstanding to be, we get a new accounts receivable number. And the difference between the two would be the cash that's been freed out of the accounts receivable that the company could use. When they start getting all this money because people are paying sooner, this would first show up in the cash account. So, what could be done with this extra cash? So, they could use it to repurchase stock, expand the business, and reduce debt. And all of that would help improve the stock price. Those were the uses for freed up cash. One other thing to consider is to talk about a little bit more about their inventory and could it be adjusted. Since the inventory turnover ratio, I'm just going to another point here, since the inventory turnover ratio is low, it appears that the firm either has excessive inventory or some of the inventory is stale, like we talked about, since it's snacks. If the inventory were reduced, this would improve the current asset ratio and the inventory and total asset turnover ratio, and it would reduce the debt to capital ratio even further. And all of that would improve the firm's stock price and its profitability. And if we just think about this company overall, if we could look back and be back in 2013, what should they have done? Well, before they took on those big expansion plans, they should have done an extensive ratio analysis to determine the effects of its proposed expansion on the firm's operations. Had that ratio analysis been conducted, then the company would have been able to see how bad it would have become before undergoing the expansion, and they would have been able to get some more things in order, like their inventory problems and day sales outstanding problems. Then we just have some potential problems and limitations with financial ratios. One is that it's sometimes hard to compare a particular company with its industry average because maybe that firm is some huge company that has many different types of divisions that are in many different types of industries. Then you can't really make a good comparison for that one company. Then you can also have different accounting practices like the LIFO versus FIFO or accelerated depreciation versus straight line depreciation. Then sometimes it is hard to tell if a ratio is just good or bad because it depends on a few other things that you have to look into. We don't always necessarily want to be comparing ourselves to the average performance like we were doing. We really want to be better than the average industry so that we can do better in our stock price. There can also be situations where, think of like if you were a Christmas store, then your balance sheet, if it was the close of the year in December, might look really different than the balance sheet of some other store that didn't specialize in as much Christmas factors. The balance sheet is that snapshot one point in time, and because of seasonal issues, that can make ratios appear to be different than they really are. Sometimes companies practice window dressing techniques and they will try to accrue revenues and they make their balance sheets, income statements look better than they really are. Some examples of window dressing that companies could do would be one would be with cash. They could postpone paying their suppliers so that the period end cash balance appears higher than it should be. Another is with accounts receivable. The company could record an unusually low bad debt expense so that the accounts receivable and therefore the current ratio looks better than it really is. For fixed assets, they could sell off fixed assets with large amounts of accumulated depreciation associated with them so that the net book value of the remaining assets appears to indicate a relatively new cluster of assets. For revenue, they could offer customers an early shipment discount, thereby accelerating revenues from a future period into the current period. For depreciation, they could switch from accelerated to straight line depreciation in order to reduce the amount of depreciation charged to expense in the current period. And then with expenses, they could withhold supplier expenses so that they are recorded in a later period. And then finally, we have inflation with the last bullet point. And with inflation, that makes many firms' balance sheets a little bit distorted. And then finally, you have qualitative factors that you should consider. Top analysts recognize that these certain qualitative factors must be considered when evaluating a company. And these factors are summarized by the American Association of Individual Investors, which is the AAII. You can look over these different questions and consider that whenever you're thinking about investing in a company.